What's up, YouTube? Stocks by the numbers. Wanted to bring you another cheaper stock here. This company is paying us a dividend, and on paper right now, actually looks like we may be able to buy some shares here at a discount. Name of the company I'm looking at, Nokia Corporation. You remember this one? Ticker symbol NOK, listed here in New York Stock Exchange. Now, this company, this is an old chart, as we see. It goes back to the 90s. I drew out some trend lines here. The bottom's coming back in 2012, and of course here, this is early 2020 when the shit hit the fan. We have our trend lines here, and as of late here, going back to 2015, you can see we're kind of in this tight little triangle channel that we're forming here. So technically, we could kind of have a break up or a break down, but looking at the numbers, in my opinion, we may have a break up. And even here, running along the bottom trend line here in the short term, if we just go to the top of that trend, we're looking at $5.90, roughly $6 a share. So we may have something that we may want to position ourselves here. Again, I always say, it's your assets, it's your liquidity, so whatever you do with your capital is entirely your own prerogative. I'm just making the video, doing a quick overview, quick breakdown here on the stock, and if you want, you can buy it, you can stay away from it, or throw it on the watch list. It's entirely up to you. Nokia Corporation, $4.84 a share, up 10 cents, 2.1% here on the day. We have a market cap of $26.5 billion. The company's trading 6 times earnings, which technically on paper is relatively cheap, yielding 1.25% here to own the stock, earning 78 cents a share. Looking here on the EPS side, we can see nice beats here back to back here for the last 4 quarters, with the big beat coming in Q4. That seems to be their best quarter. EPS coming in north of 20+% above analyst estimates. Here quarterly, we can see here on the revenue side, $7.3 billion. That's Q4 of the year before, right? Then revenue pulls back to 6, 6.25, 6.25 again, really, and then $7.6 billion. And the income off of this last Q4 was very nice, over 40%, bringing in about $3.2 billion income off of that revenue. But it seems like Q4 is their best quarter. And if you switch over here annually, though, you can see, even going back several years, this company has been maintaining this $26 billion revenue mark. Obviously, it dipped below $25 billion in 2020. However, I'm sure they probably would have hit $26 billion, no problem. And again, going 2021, you see $26.24 billion and then $26.18 billion. So they're maintaining that $26 billion mark. However, look at the profit margin, right? Minus 1.5%, flat. Then again, we had the big drop here in 2020, which means maybe they'd be right around there, maybe about 4%, maybe 5% profit margin. Then 21, 7.3% profit margin. And now 22, 17% profit margin. So if 2020 didn't happen, this company was basically kind of beelining that growth on the profitability side over the course of the last 5 years. So, you have to give credit where credit's due. That's why I'm saying on paper the company looks pretty good here. Apparently, according to the technicals, it's a buy, and even on the analyst side here, 633 here, average price target, 30% rise from where we are now. And I do think that's understandable. Again, even if we go back to the top of our range here, even if we stay in this tight range, we're looking at about $6 a share. So, I definitely say I agree with that price target, and honestly, it's probably worth even more, right? If we do our market cap to revenue comparison, they're saying the company is worth $26.6 billion, and that's basically how much they're doing in business a year. And now they're just more and more profitable than they were last year and 3 years ago and 5 years ago. So that's what I mean. That's why when we look at certain companies like this, you guys, you'll let the market pump up stocks like, Roblox and like DraftKings and shit, and it's like, this is the stock that's supposed to be getting pumped up. In my opinion, anyway. This is the company that's supposed to be reaping the rewards. So having this, let's just say double. Let's say it goes up to like 8.5. I mean, market cap will rise up to what, like 47 billion, 50 billion. Now you're trading 2 times annual revenue, right? That's basically a realistic inline valuation if you really look at it. Again, trading only 6 times earnings, you can bring that up easily to 9, 10 times earnings. So that's why again, we are kind of forming this triangle wedge here over the last several years. However, I will say chances are they should technically break it up out of this pattern and not really break it and pull it back down here to like 408, this low fib here. This is an all chart, by the way. But, I drew out our trend lines here again. Obviously this may be the highest it gets here, $18, $19 a share. I'm sure that'd be awesome for anyone holding this stock right now. However, again, even breaking up to this next trend line here of looks like, maybe about like 7.25, 740. Then you got the fib here at 780. That's what I mean. Even if we pop this out of this pattern and bring it up to 780, it's basically kind of fair valued. That wouldn't really be an overreaction. So, we may have the potential here for a $6 or $7 stock that we can buy here for sub $5. And if we switch over here and we look at some of the financials, again, yes, we looked at our revenue, our profit margin. As we see here, companies getting some business from the mobile network side, infrastructure side, cloud side, Nokia Technologies. And apparently they're all over the world here. A lot of business here in the U.S. and over there in Europe. India is a huge market that they're in, of course. The Middle East, growing. So all of this is looking pretty decent here. As we see on the revenue side, one hit, one miss, alternating year over year. That's a slight miss. About 1% miss and about a 1% beat, and then coming in with a 4.6% beat, over $1 billion above estimates. And if we look here for 2023, $27.75 billion, coming off of $27.04 billion. So, being that the company maintained that 27 billion, seeing this jump here to 27.75 billion may actually be a little bit high for this company. However, their Q4, as we looked before, continuously seems to be growing. So if the Q4 can really jump up for them here in 2023, then they may actually come with their back-to-back beats year over year and look even better. On the EPS side, you can see 4 beats in a row here year over year, posting 48 cents for 22, above estimates of 42, and now look at 23, estimates of only 46 cents. So that's why I'm saying, if they can slightly bring that revenue up and get very close or at least meet that 27.75 billion, all they really got to do is maintain what they're doing right now. And if they come in with 48 cents again, it'll be above these estimates of 46, and of course it'll be another beat, at least 5 years in a row, and the stock, in my eyes, will probably take another leg higher. As you see here, the company was paying 9 cents a share back in 2018 and then cut its dividend and has now started to pay it back to shareholders here 6 cents a share, again yielding 1.25% dividend yield. As we see here, the debt back in pandemic was $8 billion. And if we watch the debt just pull back to 6.4, 5.89 billion, and even though the company has spent some cash, they're still sitting here with roughly $900 million. And it's never a bad thing to have cash on hand if they do happen to hit a speed bump, or if one of their segments or divisions begins to start lagging. Who knows? They can step in, they can buy some small cap tech company to try to positively impact their overall business, and throw them $500 million in cash and a couple of shares, and boom, just take over a company and get ready for the next year or two to begin to implement that technology just to make the business overall better. And also we can see here short-term liabilities, 21.6 billion. Short-term assets, 21.6 billion. Short-term liabilities, 13.6 billion. And 27.1 billion on the long-term side, 12.25 billion. Police car going by, 12.25 billion on the long-term liability side. And if we add these up, we have roughly $50 billion in assets and about half of that in liabilities. So we have a very nice 2-to-1 ratio on the asset to liability side. So that's why I'm saying on paper, this company really isn't looking too bad right now. The assets, again, climb back up to 49 billion, coming from as low as 45 when it was around 49.50. So that's what I'm saying. The company is now, they were at a high and now they took their dip down and now they're climbing back out of it. You understand what I'm saying? So that's why it's getting better and better for the last year or two. And in my opinion, 2023, who knows? If they continue this trend, they will potentially get back to that $50 billion mark in assets to finish 2023 nice and strong. Again, liabilities was as high as it was back in 2020 at one point. Was down at 27 billion from that 31.25 billion on the liability side. However, as of late, 31.17 billion. 2 years ago, 28.6 billion. Last year, 25.8 billion. Lowest it's been since 2016. Big drops there, bringing it down 8% and then 9.5%. So that's why Look at the equity growing back up to 22.87 billion, the most it's been since 2016. And again, the debt, as we looked at, was up to 8 billion, significantly higher than the years before, but has since pulled back 6.4, 5.8. That's why I'm saying, in my opinion, the company really seems to be trending in the right direction. The debt ballooned up to 4.1 billion, and they brought it down almost a billion year over year. So that's why if they come in with this number again at like 2.3, 2.2 net debt for 2023, you're seeing the company trending in the right direction, taking its cash, paying off its debt and its liabilities, and of course paying it back to shareholders as well, repaying that dividend over the course of the last year or two. The book value, as we see here, was in the high threes, pulled back to as low as 272, and then in the last 2 years has just began to pop and drop, baby. Well, not pop and drop, but you know what I'm saying. So it goes from 272 up to 3.5, now sitting at 408 book value per share. Stock's only trading at 484, right? So that's why it's like, any way you really look at it, it kind of looks pretty good here in my eyes. We come down here, let's look at our valuation ratios. As we see here again, PE trading about 6.1 times earnings, was a little bit lower than that, was a little bit higher than that. Trading about 1 times sales, 17.5 times cash flow. Again, we looked at the cash flow, roughly 900 million. And book value here trading 1.16 times book, which before last year is still technically the lowest and cheapest it's been in several years. That's why I'm saying, again, is it going to go to the moon and explode to $20? Chances are probably not. But, I mean, again, going back to those trend lines we looked at before, this thing can easily climb up to, 5 3/4, 585, 605, right? There's really no reason why it can't at least get back to the top of the range and hang out there, because it seemed like it was kind of hanging out at the bottom of the range here for the last, I'd say, I don't know, a couple of months or something. We'll go back, we'll look at the chart. But coming over here to our profitability ratios, again, this is really the health of the business, right? Because they always hate on a lot of these stocks because, yeah, they may be bringing in a lot of revenue, but they're not profitable. They're not making any income for themselves off of said revenue. So that's why the profitability ratios show you sometimes a larger, broader picture that, just an earnings report may not show you. Oh, yeah, they missed on revenue, they beat on EPS. Sometimes it really doesn't mean anything unless you look at it with these metrics here. The return on assets was slightly negative, went flat, slightly negative again, and then exploded up 4%, now 9%. All of these numbers basically followed the same pattern, so I'm just going to look for the last year or two for you guys, save some time. Return on equity, same moves here, massively negative, got up to 11%, and then almost doubled here to north of 20%. Same thing on invested capital here. Negative to 8%, and then a double basically up to 16%. The gross margin percentage, this has been, basically in the low 30s here. Got as high as about 37.5 a couple of years back, and has since climbed up and bumped up into the 40s, now sitting here at 43.5%. And the operating margin as well has been slowly climbing. Look at these numbers here. Flat to 3.6, slight pullback here, 2.45. And then look at these jumps. 6, 9, 7, 10, 7, 11.3, now at 16.3. The EBITDA, basically same exact story. 6 3/4%, up to 10.5, pulls back to sub 9, and then look at this, 13.1, 14.9, 15, 15.9, 20.3. Phenomenal. And the net margin, again, as we looked at before, was slightly negative, went flat, pulled back negative, and since has begun climbing to 7.3, 16.8, now sitting here north of 42.3%, excuse me. So that's why a lot of these numbers seem to be trending in the right direction. The one thing that caught my eye, which you can understand as of late, the company not really taking off, the inventory turnover that we have been looking at. As you see here, several years ago, 6 3/4%. Now it's pulled back here into 4.9 and even the low 5s. But again, not really the biggest red flag in my eyes. I'm really not seeing the big issue here. You're seeing a breakdown of revenue here again. Their mobile networks, their network infrastructure, cloud services, as you see. Mobile networks took a big hit. However, they're bringing in, this is a decent number. They're bringing in about 10 billion from network infrastructure. And again, cloud's bringing in a couple of billion. So this company basically is doing what it has to do to maintain its business model. And again, they began paying shareholders again, right? So you can say, well, it hasn't really done much for the last year or two, but usually when a company declares it's repaying a dividend, they're taking cash out of their own pocket to give it back to shareholders. So technically, the stock value, the value of the company is going down because the company now has less cash on hand. They're giving it away. You understand that logic? So that's why I can understand how, even though the numbers have been coming in pretty healthy, they kind of maintained this flatness on the stock, perhaps in the last 2 years since they began paying out dividends. But overall, the business, again, seems to be looking pretty good. In the United States here, we have slow and steady growth here year over year, up to north of 8 billion now here in 2022. Europe, again, was, 3, 4 billion, now up almost 6 billion here. The India market is growing. They grew the market in the Middle East and Africa here. All of these numbers look pretty decent. So that's why, again, in my opinion, even looking at the technicals, we're drawing out our long-term, top and bottom trend lines here on our support and our resistance spikes. But again, we're in this tight little triangle wedge here. And in my opinion, the fact that we've been riding this bottom trend line since, what are we looking at here? September, October. That's what I mean. That's why I'm saying it's most likely, in my opinion, going to break above this simple moving average here and begin to climb back 593, 597, 6 back to that top trend line. And if it does break out again to this other trend line here, 7.5, 760, even this fib here of 780, it actually is justified because, again, that would bring the market cap only up to about, low 40 billion. And the company, again, is bringing in 26.5 billion or whatever for the year. So that's why it would really not be too crazy. And the fact that it's been trading at the lower trend may be a buying opportunity for you. But again, that's just my opinion. But overall here, looking at the fib levels, even backing them up, you can see, you see the next fib there at 503. That's why you had a lot of bounces, a lot of resistance off of that, multiple occasions. But you can see here now, on the 5-year, it is closed above that moving average. On the 1-year, the stock is now above all of these fib levels, and same on the 6-month and the 3-month, getting above that top fib of 479. The 1 month, you can see, though, the top fib of 484, and that's where the resistance is coming, as you see here, multiple rejections off of that 484 level. If we pull back the 5-day chart, you can see just got above those tight fib levels and is now also sitting above that moving average. And now on the 1-day, you can see the fibs of 483, 484. That's why once it got up to that level, it did slightly dip back down here, 481, 482. However, it's kind of been maintaining that tight flatness for quite some time, because that is going to be the main resistance. However, understandable if it breaks above it. If we switch over here to stock charts, we're looking at our pivot points here, and you can see our first resistance level is right here at 484, which is exactly where the stock closed. However, it has been pretty bullish, bouncing off that support of 445, going back about 2 weeks ago, we'll call it, and it has been pretty bullish and bounced above both of these 50-day and 200-day moving averages, respectively. The MACD has curled up and has basically continued this upward momentum, which is why we could potentially have the breakout here above this resistance going into the 490s, 495, potentially $5 a share. RSI, 61.86, still not too high. So that can still climb an easy 10, 12 points technically. So that's why I'm saying we may touch up to 5 before it may sell off a little bit and retest this support here now of 484, and then potentially take another leg higher, climbing into the low 5s. If we switch over here on the weekly, look at this pivot point, 496. Right here. That's why I'm saying you could, in the next day or so, see it pop up to that 496 level. Definitely realistic. Looks like it's forming a bullish hammer here on the weekly and is now sitting above both moving averages again, the 50-day and the 200-day respectively. And I do think it's ready to take another leg higher. Look at how tight this is now trading. I mean, this is the tightness you look for. Again, look at that MACD curling there. Looks like it's about to bounce and continue upward. That's why I'm saying I do think that this break is going to happen. And again, this top resistance, 589. That's what we were looking at, right? That's what we were looking at. If we look at the top of our triangle, right? That's what I'm saying. Even if we come out here, July, I mean, that's going to take a couple of months, but you have earnings coming up here, and then that's the top of the range there, $5.90, $6, earnings coming out April 20th. So they're most likely now having it ride off and bounce off this bottom trend line. In my opinion, they're going to bring it up a little bit. They're going to calm down the RSI and have it retest and bounce off that support, and they're probably going to run it up going into April, going into these earnings. And these earnings, in my opinion, if they come out bullish and they have a beat on the top and bottom line, they're most likely going to break that trend and potentially pop it out of this long-term channel here. As we see here, going all the way back from 2014, I drew this trend line. However, I do think that this is the channel it's really trading in here. And I do believe that it will climb up here 5.5 and into earnings and break higher. But again, that is just my opinion. Some of you may not like the company at all and may think the breakdown is wrong, and you may see it pulling back to sub $4. I always say, let us know in the comments section. Love to hear all these different viewpoints. If you happen to own the stock, you grabbed a position maybe a couple of years ago for whatever reason, let us know in the comments down below. Let us know, what price you stepped in. Let us know what you expected, what you were predicting when you made the purchase. Right? I'm sure you were confident on that day when you said, okay, I'm buying. So why did you buy? Did you see, tremendous growth happening in the next 3 to 5 years? Did you feel they were going to start beefing up their dividend again? Let us know what your overall vision was for the stock as well. But yeah, I'll leave it there. So if you have any questions, comments, or concerns, drop it in the comments section. Like the video, thumbs up, helps out the algorithm. Subscribe to the channel, means a lot to me. And like I always say, though, moving forward, I understand that markets are rocky, they're volatile, and they're uncertain. So I wish everyone success. I hope everyone makes a couple of dollars. Thanks for stopping by. Catch you guys in the next video.